The year was 1923. A German worker gets paid twice a day, not as a perk, but as survival gear. At lunch, his wife is already waiting at the factory gate. He hands her a stack of notes. She dumps them into a wheelbarrow and sprints to the bakery before the price of bread doubles again. By evening, his second paycheck won't buy what breakfast cost. That's not a recession. That's what it looks like when a government decides the easiest way out of a debt spiral is to quietly torch the currency holding everyone's savings. When countries get buried in debt, they don't sit in a conference room and design a noble, orderly solution. They really only have two options: explicit default, which is political suicide, or silent default, inflation. Today, we are going to look at three countries that picked door two, started inflation wars, and lost. Those three are Weimar Germany, modern Argentina, and ancient Rome. Throughout history, the leaders typically pick option two, not because leaders want inflation, because the incentives push them there. To see why, you have to see how the pattern actually behaves, and that means going back to the moments when the math broke. Here's the clean version. When debt payments grow faster than tax income, governments run out of good options. Raise taxes, voters revolt, cut spending, protests, recessions, lost elections. That leaves the option no one admits out loud. Print new money, use it to pay old obligations, let inflation quietly reduce the real value of what's owed. Creditors get paid back in a currency that now buys less. Economists call this inflating away the debt. Savers call it theft. Politicians call it survival. But it only works if people trust the currency. Once that trust cracks, inflation stops being a policy tool and becomes a runaway feedback loop. Let's start with the original horror film, Weimar Germany. After World War I, Germany gets handed a bill. The Treaty of Versailles demands 132 billion gold marks in reparations, more than Germany's entire annual economy at the time. In today's terms, you're talking about a bill in the hundreds of billions of dollars laid on a defeated, broken country. Taxing that out of people is political suicide. Growing out of it is mathematically impossible. So the Weimar government reaches for the escape hatch. In 1921, they start printing paper marks to buy foreign currency and make the payments. On paper, they're honoring the debt. In reality, they're diluting the currency that debt is measured in. At first, it feels manageable. A little inflation. Prices creep up. Wages adjust. People grumble, but life goes on. Then the loop locks in. More printing means more marks in circulation. More marks mean the mark is worth less. The mark is worth less, so prices rise. Prices rise, so workers demand higher wages. Businesses raise prices again just to survive. And the government, trapped by its own promises, prints even more to cover wages, subsidies, and those foreign bills. By 1923, the currency isn't just weak, it's disintegrating. In early 1920, one US dollar buys about 65 marks. By November 1923, that same dollar buys 4.2 trillion marks. A loaf of bread in Berlin that cost a couple hundred marks at the end of 1922 ends up costing around 200 billion marks by late 1923. At that point, menus are pointless. Prices change by the hour. Workers rush to spend wages within minutes of being paid, because holding cash overnight is like leaving ice cream on the sidewalk at noon. Adjusted into today's dollars, a $3 loaf of bread would cost $2.4 billion within 10 months. This wasn't just economic pain, it was the destruction of trust. Bondholders lost everything. Lifelong savers were wiped out. Anyone paid in fixed incomes became instantly poor. But borrowers, they repaid debts with worthless paper. The middle class fractured. The political system destabilized. Extremism surged. Hyperinflation didn't bring chaos. Hyperinflation was the chaos. Weimar isn't just a story about bad money. It's a case study in how a currency crisis can turn into a political crisis, fast. Underneath all the chaos, the mechanism is simple. The government can't afford its promises, so it chooses to pay them in full, in units that are worth less and less. On paper, the debt gets honored. In reality, it gets defaulted on. Once you see that, Argentina and Rome stop looking like random trivia and start looking like reruns. Now let's jump to Argentina. the place where the inflation horror franchise never quite ends. Argentina has defaulted on its debt 9 times since independence. Remember, defaulting on debt is door 1 and rarely taken. Door 2 is inflation. And Argentina's inflation track record is even more revealing. Argentina didn't have one inflation crisis, it had a series. In 1975, inflation hit 183%. By 1985, 600%. By 1989, more than 3,000%. The peso collapsed. The government renamed the currency 5 times between 1970 and 1992, a reset button that never worked. Why didn't it stick? Because every time inflation slowed, the government returned to the same play: borrow, spend, print, repeat. By 2023, inflation hit 211% again. A pattern, not an accident. When a presidential candidate wins on a platform of abolish the central bank, it's not ideology. It's a population that has lost faith in the people running the machine. If Weimar is the car crash in slow motion and Argentina is the reboot, Rome is the version that plays out over centuries instead of years. In the early empire, the denarius, a silver coin, is the reserve currency of its world. It's trusted from Britain to the Middle East. But Rome hits the same wall every empire eventually hits: endless military campaigns, expensive borders, welfare for citizens, corruption and bureaucracy. Expenses climb faster than tax revenues. Rome doesn't have a digital central bank. What it has is the imperial mint. So emperors start running the ancient version of money printing. They quietly reduce the silver content in the coins. Around the early imperial period, the denarius is more than 90% silver. By around 200 AD, that purity has fallen to roughly 50%. By the late 3rd century, under Aurelian and his peers, some coins are down near 5% silver. Basically copper, with a silver wash. Face value, unchanged. Official story, unchanged. But the substance underneath the symbol is gone. Prices rose 200-fold. Soldiers refused payment in debased currency. Merchants demanded gold or barter. Tax collection broke down. The state weakened. The tax base erodes because people exit the monetary system. And when your tax base and your army both stop trusting your money, your empire's ability to project power dies with the coin. Rome didn't fall and then lose control of its currency. It lost control of its currency and then fell. 2 centuries of erosion started with one quiet incentive. It was easier to dilute the money than solve the underlying fiscal problems. Put these stories side by side, and the pattern stops being mysterious. Governments pick inflation over explicit default because it's the least visible pain. There's no line on your paycheck that says, inflation levy minus 7% real purchasing power this year. You just notice your rent doubled. Groceries are up 30%. Your safe savings account buys less every single year. The story repeats because the incentives repeat. Stage 1, debt becomes unmanageable. Stage 2, raising taxes becomes political suicide. Stage 3, cutting spending becomes social suicide. Stage 4, printing becomes the path of least resistance. Stage 5, inflation starts slowly, transitory. Stage 6, trust cracks. Stage 7, currency resets, restructures, or collapses. This pattern doesn't depend on ideology, it depends on math, and the end game is always the same. Either you get full-blown hyperinflation, or you get a brutal restructuring where savers eat the losses. Here's the thing, we are not Weimar, we are not Argentina, we are not Rome, but we are living with their incentives. Global debt to GDP is at historic highs. Governments now spend more on interest than on defense. Central banks expanded money supply at historic speed in 2020. And they haven't unwound much of it. Inflation has cooled from the peak, but not fully reversed, and real yields remain negative across much of the developed world. That's financial repression. Inflation stays higher than interest rates, quietly reducing debt burdens. It isn't an emergency, it's a policy choice. And it fits the oldest pattern in the sovereign playbook. And here's the key point. Almost no government sits down and says, let's destroy our currency. They're just trying to survive this year's budget, this election, this crisis. But once the printing habit is installed, stopping it means accepting the very pain they were trying to dodge. That's why the brakes usually get slammed after a crisis, not before. So where does that leave us today? No, the US and Europe are not Weimar Germany in 1923. You're not using a wheelbarrow to buy groceries. But some of the warm-up stretches look familiar. Global debt, public plus private, sits around the mid-200% of world GDP, near record highs. Central banks created unprecedented sums of money during COVID through asset purchases and emergency programs. And inflation answered. In the US, inflation jumped from roughly 2% to over 9% at the peak. The fastest move in about 40 years, before coming back down. Interest rates then went from near zero to above 5% in a very short window. Now governments are rediscovering the downside of that combination. Rolling over trillions in debt at higher rates is expensive. Interest costs threaten to crowd out everything else. Central banks talk about shrinking their balance sheets and keeping rates higher for longer. But the unwind is slow and politically fragile. If rates stay high long enough, refinancing the debt becomes painful. If rates get cut too aggressively, inflation risks coming back. At some point, the pressure to do something, protect growth, calm markets, rescue overextended borrowers, gets intense. And the path of least resistance looks a lot like this. Let inflation run a bit hotter than the official target. Keep real interest rates, after inflation, negative or barely positive. Gently herd big investors like pensions, banks, and insurers into holding government debt. That's financial repression. Your bond gets paid. Your savings account exists. Your pension statement shows the promised number. But in real terms, the purchasing power behind those numbers is being shaved down year after year. It's inflation as policy, just slow enough that most people don't connect the dots. Here's where this stops being just a history lesson. If you hold mostly cash or long-term fixed-income assets during an inflation war, you're volunteering to be the shock absorber. The winners in every inflation war are the same. People who hold assets that the government cannot print. The losers are also the same. People who trust that cash will hold its value. So let's pull it together. Weimar Germany, Argentina, ancient Rome. Different eras, different cultures, different institutions. Same basic move. When the math stops working, governments raise taxes a bit, cut spending a bit, and quietly lean on the printing press a lot. They call it stimulus, liquidity, accommodation, support. The labels evolve. The incentives don't. Debt gets inflated away. Savers pay the bill. History doesn't repeat. But the incentives do. The question isn't whether governments will choose inflation. It's whether citizens will recognize the pattern when they do. This is Money Margins. Thanks for watching, and I'll see you next time.